Welcome to COVID-19 Impact and Outlook Alternate Investment Markets webinar. I'd like to start by introducing Laura Sexton, Senior Director of Program Management. Laura?
Hello, everyone, and thank you, Jen. And before we really even get started here, I wanted to say thank you so very much to our speakers who have joined us. I know this is a very stressful and busy time for them and for all of us, but for them especially, kind of managing the funds. I can't thank them enough for being here. I'm really excited to hear what they have to say and interested in it and grateful we're able to talk with them. And for all of our listeners, thank you as well for taking the time to listen. I know you're busy too, and I hope you and your families are safe and healthy and everyone's staying as sane as you possibly can through this pandemic that'll probably really change the world as we know it for a very long time. So everyone stay sane if you can. So anyways, by way of an agenda, I'll walk through, I'm going to introduce our speakers. We're going to walk through questions with our speakers. They'll each talk a little bit about expectations for returns and volatility within their areas of coverage. We'll review a due diligence action list and then open up the call for Q&A. So we have a lot to get through. We may move sort of quickly, but there will be a replay, and I will be putting together some key takeaways to send around as well, since I know everybody's kind of being inundated by a lot of information right now. So let's get started. I'm going to go ahead and introduce our speakers here. So first of all, we have Dr. Randy Anderson, who's the president of Griffin Capital Asset Management Company, as well as the chief economist of Griffin Capital Company. Dr. Anderson is also the chief investment officer of Griffin Capital Advisor, and he serves as the executive vice president, secretary, and trustee of the Griffin Institutional Access Credit Fund, as well as he's the portfolio manager for the Griffin Institutional Access Real Estate Funds, both of which are interval funds. So next we have Robert Hoffman, who's a managing director of investment research at FS Investments. He leads the research team that analyzes the fundamentals behind market movements, obviously something we're all very interested in right now. He looks at the macroeconomic trends and the performance of specific industries. And he served as a loan portfolio manager and senior credit analyst and focuses primarily on corporate credit markets. And then third from Nuveen, we have Richard Kimball, who's the lead portfolio manager and executive officer for the Nuveen Global Cities REIT. He oversees the strategic allocation and for the fund and the North American segment of the portfolio. He's focused on structuring and managing debt and equity components of commercial real estate, and really has been involved in all aspects of real estate, from acquisitions to dispositions. So again, welcome to all of our speakers. We have a great panel here. Thank you for joining us, and we're really lucky to have you. So let's get started. We're going to start talking about our first set of questions, which is really going to be about markets and opportunities. And so, Rich, let's start with you. Since you manage a global real estate fund, could you tell us about Nuveen's outlook for the economy in general, and then kind of for real estate in the U.S. and globally? Does this potentially change the global investment in U.S. real estate, or vice versa? And kind of what's the outlook for real estate here? If you can take that one.
Sure. First, appreciate you having me on the panel today. I thought I'd first just touch on our overall view of the economy, which will be broad, and then I'll kind of touch on where we think each sector is positioned as we get through this crisis. But first, we think there's a number of factors for the economy and the recovery. While the equity market appears to be anticipating a V-shaped recovery, and we believe the amount of fiscal stimulus will definitely help fuel the recovery. That being said, I think we still have to look at the jobless claims, potential or unemployment, and what that could do for real estate demand in the near and medium term. Hospitality, gaming, discretionary retail, senior housing, and student housing will be the hardest hit and probably take the longest to come out during the recovery. Also, development, value-added, or properties with leasing needs are going to struggle in the near term, as just leasing is just slowed pretty much to a halt throughout all regions, with Asia coming back a little bit quicker. Regarding retail, non-discretionary properties such as grocery anchors are typically insulated during recession, and specifically during this pandemic. And then discretionary centers who are going to be obviously hurt the hardest, with some retailers closing for good and some centers needing to be redeveloped into other uses. Regarding office, we think it will be mixed with commodity office properties and properties with co-working exposure being hit the hardest. We anticipate West Coast office with a heavier concentration to tech firms will outperform East Coast. Clearly, Houston's going to struggle with what's going on in the energy sector. Looking at some sectors that we think will perform better overall and we'll look to gain. Industrial should be a winner with the increase in e-commerce sales. That being said, we were watching for disruption within the supply chain, specifically on the West Coast in the US and then in Europe, with companies reducing their dependency on China. But overall, we think industrial will perform very well, given the increase in e-commerce growth. Then housing, while we were bearish on senior and student housing before the pandemic, given supply-demand fundamentals, we do like traditional housing, such as apartments and single-family home rentals, given demographic tailwinds. So as we have dry powder to invest, we're really focused on industrial, housing, technology, and healthcare-related properties, such as life science and medical office. Regarding investment in the U.S. by non-U.S. and by international investors, I do think as we come out of this, the U.S. will continue to be a safe haven with certain sectors and cities attracting more capital. Regarding U.S. investment in Europe and Asia, I think within Europe, you'll see more of a cities-based approach, as most countries are having slower growth, slower demand, but certain cities have young populations and are continue to grow. So definitely more focused on cities. And then with Asia, you can't ignore the growth prospects there. I think the key is to gain product. You really need a presence there or boots on the ground, as it is hard to come by
Sure.
quality product within those regions.
Yeah, and one quick question for you too before I switch speakers. So in terms of the kind of Asian investment, I guess in New York and some of the bigger cities on the East Coast, with everything that's going on, there's kind of things floating around that maybe Manhattan after all this isn't quite as attractive as it was. Maybe people move out, don't favor it as much. I mean, you sort of hear that, but then you hear alternating that, the alternating story or the other side that's not going to change. It's not going to change the dynamics that are already in place. It might be sort of temporary, but what are your thoughts on that?
Yeah, I think it really speaks to when you're developing a fund and making investments, you want to be diversified, not only in cities, but also sectors and tenant industries. It's my opinion that New York doesn't go away, but you may see companies looking to diversify and putting offices in different areas within the country, just
Right.
given where their employees want to work. But to me, when you're investing, you want to focus on being diversified.
Sure. Okay. Great. All right. Good. So then let's switch over to Rob. If you can kind of talk a little bit about the debt markets and do you think the market dislocation has created opportunities in the debt space, and are you able to kind of properly assess the opportunities? And I know you cover a couple different areas of the credit and debt market, so maybe you could tell us a little bit about what you're thinking in terms of the situation, the current situation, and the outlook for the different sides of the debt and credit markets.
Sure. Yeah, and thank you for the question, and thanks for inviting me to participate. The debt markets, there are definitely opportunities, right? I think you can look back at previous times in history when you see some of these types of dislocations. You can look at a market like the high yield market when spreads cross 900 basis points, which they did a few weeks ago. The median 12-month forward return is about 36%. Even with spreads at 800 basis points like they might be today, your forward return on a median basis over 12 months is 26%. So, it's very easy, I think, to look at the pain that we've all felt, the sell-off. While there's been somewhat of a moderate recovery, there's a lot of upside that's potentially there. And I think, if you look across markets, whether it's traded high-yield bonds or traded loans, structured, CLO securities, as well as even in the real estate debt markets, definitely opportunity. That opportunity is there for a reason. There's certainly a bit of pain to get there, and I think, markets will struggle with issues from things like rising default rates, the carnage in energy, the anticipated amount of fallen angels or companies getting downgraded from BBB into BB or lower, retail fund flows, the inability for new CLOs to be issued, which could create a lot of problems as it relates to demand for corporate loans, for instance. So it's not that there's not problems, created by the economic situation. But I think these markets, certainly on the corporate debt side, have proven to be resilient over time. There's never been 2 years in a row that the high yield market or the loan market has had a negative return for 2 straight years. It's never happened in history. And high yields only ever had 7 negative annual returns, going back to like 1990. So I think there's a lot of good attributes. It's got to be done very carefully. You've got to have a very deep view and understanding of credit. And I think analyzing it, company by company, sector by sector. I'm not sure it's the right time for broad, passive allocations to some of these markets. But I think that volatility and, the questions that it creates definitely creates opportunities in these markets.
Yeah, and another kind of thing on the debt markets, I think, we all experienced the last recession and how difficult it was for anyone to find liquidity and find capital when they needed it. And I guess the question I have for you is do you think this feels like then? Like, does it feel like if, companies are going to really struggle, and including the commercial real estate, on the commercial real estate side, does it feel like a tighter liquidity squeeze, I guess, than it did then? Or does it feel different that it's, because it wasn't necessarily caused by the financial markets, and kind of a liquidity issue? Does it feel different to you, or does it feel similar? I'm just curious your thoughts on that.
Yeah, one of the things that was really interesting about this sell-off to me is, you think about things, prior to 2 months ago, and a lot of the press on the corporate debt market, was focused on the growth in the high yield market, the amount of low-rated issuers, the problems that was going to create. But nobody was writing about, the growth in investment-grade bond ETFs, right? And really I think one of the issues that arose in this sell-off came from some of the investment-grade ETFs starting to trade at major discounts because they couldn't liquidate positions fast enough to meet redemption. And to me, that then, cascaded into structured products markets, and you saw sell-off in RMBS and CMBS, and that spread into investment-grade structured product debt. And then that to me, kind of caused this next leg down in sub-investment-grade markets. And so I think there was a little bit of liquidity squeeze, but I don't think it necessarily came from where people expected, and it certainly came from a different place than what we saw back in the financial crisis, when the liquidity squeeze was very much born out of the senior secured loan market and the high yield bond market to a certain degree. So, I think we started to see a normalization of that. Certainly one thing that is different this time around is the speed to which the Fed stepped into the market and provided very big dollar amounts of support to try to stabilize some of these areas that I think they identified as weak very quickly. And I think we have, some optimism that not that that's a cure-all. We still have a lot of issues and everything's still shut down and we're still doing this from home. But, if we can keep markets functioning normally to allow people to price risk normally, then that can be a very good thing for markets, and hopefully can get us through this faster than it might have otherwise been if you had a 2008 style liquidity crisis.
Yeah. Okay. Perfect. That's great. All right. So, Randy, why don't we switch to you, and if you could maybe tell us a little bit about your expectations and your firm's expectations for the economy in 2020 and then 2021. Given kind of the onset of COVID, that'd be really helpful.
Sure. Thank you for having me on. And listen, I appreciate being on with a couple of other great panelists. They in parts of their question addressed really a lot of what our view is. But I'll try to put a little bit more meat on it and really sort of focus on sort of just the economy, if you will. As it was just said, we're doing this from home. I mean, we had a hard stop on the economy. If you look at it, we've lost the same number of jobs, really, that we gained all the way going back to the global financial crisis till today. In fact, the April jobs report's likely to show 25 million, plus losses in jobs. And, these are numbers that are unprecedented. So clearly, we're going to find that we are in a recession. We'll have definitely a contraction in Q1, and the contraction will be larger in Q2. Now, if you look at sort of consensus forecasts, the consensus kind of varies, and it really has to do with timing. Whether it's Q3 and Q4 or Q4 to Q1 seems to be a lot of the question. And one of the reasons that people are optimistic, I think as both former speakers talked about, was that 2 of the 3 legs of the chair are really in place to provide some reflex to the marketplace. So, today we just found out a couple minutes ago here that we passed another stimulus bill. So there's a lot of fiscal policy in the market. There was already a couple of $1 trillion passed, and we just got, another large package approved primarily for small businesses. On the monetary side, I think that was really important. Our previous panelists, really hit it on the head. There was a time where, some ETFs, even on the high yield side, looked like they might break. I mean, on the investment grade side, there was times when people looking for safe havens like gold, they were selling everything to grab liquidity. It's hard to think about a market that trades on PE, price to earnings, and there's absolutely no visibility onto the E. And so the Fed's stepping in, while there may be some, consequences that occur later, I think was very necessary to get the market trading in a manner which is at least orderly to a large degree. To put a little meat on that, just to remind everyone how big the Fed stepped in. We had a 50 basis point cut in March 3rd. We had another 100 basis point cut on the 15th. And then on the 17th, 18th, and 19th, and 20th, we were buying, commercial paper, support for the money market fund, support for currency swaps, muni support. And on the 23rd of March, we stepped in and said, listen, there's probably unlimited amounts of asset purchases going on. And on April 6th, there was support for the payroll protection plans. And on the 9th, we started talking about buying corporate bonds, even fallen angels and state and municipal bonds there. So really, part of the question is on the recovery is really that third leg of the stool. And I think the third leg of the stool is the biggest unknown. And I think that's what's really driving the uncertainty in forecasts on GDP. And obviously, as GDP goes, ultimately, risk assets will end up going. So part of the question is on the virus and when we can open back the economy. And I think we're seeing things. We're seeing parts of Asia open back that was hit first by it. We're seeing countries in Europe starting to ease restrictions that are occurring. In the U.S., we saw over the last, 24, 48 hours, we saw several states starting to relax their requirements. But to get things fully back to normal, we really need a vaccine. And even in the meantime, it's going to be data dependent to see the rest of the economy open back up. They'll be looking at things like new infections, new hospitalizations, deaths, and ultimately testing and tracing ability in order to open up the economy. And that's not simple. It's still going to require things like social distancing. It's going to require ways to effectively get people in dense areas, have the public transportation working in a safe way, and ways to take care of children as well. So I think our view is largely the same. We have reason to be optimistic. We certainly think the economy is going to recover. We're more of the camp that the economy is going to recover getting better in Q3, but really the recovery starting more in Q4. Rather than give you sort of Griffin's numbers, I'm gonna give you two numbers sort of on GDP as we go forward. One is from a real estate firm. CBRE has an econometrics advisors unit, and they came out with their all-in sort of 2020 forecast. And theirs is really 2 quarters down and 2 quarters up strong, showing a base case downturn of around 3% in 2020, and in 2021, actually, because of recovering economy and all the monetary and fiscal policy, or legs 1 and 2, of 5.9% growth in 2021. We're probably a little closer to that of the IMF, so I'll use that as a second one, where GDP is likely down around 6% for the calendar year 2020. Recovery starting a little bit later, and I think some lessons learned when you start to look at the rollout of opening back economies. There's always like 2 or 3 steps forward, but maybe a half a step back. But strong growth in 2021, kind of moving into that 4.7 number. But the risk, if you will, to forecast is to the downside with respect to the virus and ability to reopen the economy. With all that said, without really going past the economy, I think what we talked about in terms of some of the stability that we're starting to see in opportunities, both in the bond and just equity markets, suggest that we will get past this virus, and pillars 1 and 2 have probably shrunk the equity risk premium a bit, and that's why we've seen markets stabilize, trade a little bit better, and some of the largest amounts of fear have been removed, at least for now, in the marketplace. And that should bode well as we move forward. It should bode well into the real estate and credit markets.
Yeah, great. That's perfect. Yeah, and I've listened to some of those CBRE forecasts too. If anyone listening on the call, they've got some pretty good, interesting webinars and reports on their site. Actually, it's kind of some interesting things they've got on there. So worth taking a look and listening to some of them. So let's now dig a little bit further, Rich. If we could talk with you just a little more specifically, as kind of specific as you can, I guess, on kind of the tenants in the real estate world, and if you could speak a little about how tenants are reacting and kind of the things that your firm is doing to be proactive in working with tenants. So, are they able to pay their rents? Are they asking for deferrals? Or you hear about, MAC clauses and different things maybe being used. I mean, is it coming to that, or are you, able to kind of be proactive enough in working with tenants? How are things going on that side?
Yeah, happy to touch on that. So at the beginning of the month, we did see a little bit of tenants who were well capitalized, opportunistically or fishing for potential relief when they didn't really need it. We kind of weeded through that. There was an article early in the month that said in the U.S. 1/3 of apartment renters didn't make their payments. I think that was premature. We definitely have not seen that in our platform or for the Global Cities REIT. Our platform, we've collected month to date about 94%. For the fund I manage, our apartment portfolios collected over 97%. And you've had some tenants a handful of tenants ask for payment plans that we're definitely working with them if they're in a hardship scenario. I think for the force majeure, we're not really within our leases. That can't really be used for tenants to not be able to pay their rent. That being said, we are working with small businesses that have had business disruptions, or it's really the retail tenants. The grocers are doing fine. The larger tenants are doing fine, and it's the small businesses that have had to close because of the shelter in place. And we definitely understand that, and we want to be part of the solution and make sure as many companies stay in business as we come out of this as we can, and keep as many employees as they can. So we're working with them. We're not abating rent, but it's a deferment.
Okay.
And for retail inline where they've closed, we've said defer rent the next 2 months. We can amortize it over the balance of your lease, or we can add on term to the end. And another thing Nuveen Real Estate is doing as a platform is we've put together a task force and set up a hotline that we're working with. Any small business can call us, and we're working with them to get through the processes of obtaining funds, whether it be from the Small Business Administration or from their their state or local governments, so they can get funds to stay in business and eventually pay rent. But that's something we're doing.
Okay. Yeah, it's interesting, the amortizing, that kind of some of the specific strategies that you can use, because you hear things like, well, it's just kind of deferring the pain right now, right? I mean, you get away with kind of not paying right now, but does that, cause more pain down the road? But I mean, it sounds like there's some other kind of creative, strategies that can be used to kind of, ease that pain kind of over time, and still
That's
allow
exactly
them
right.
to.
And it's a case by case basis.
Right. Okay.
Part of the solution, and try to keep
Yeah, and I mean the other thing I find interesting too is just how much. I mean, you kind of talk about real estate. One of the the big aspects of it is, I mean, rent is always first, right? And you got to pay your rent. It's one of the kind of benefits of real estate, and it really is true. I mean, you hear tenants are most worried about being able to pay their rent. It's the first thing they're worried about right now, and so it really is kind of an interesting. I find it interesting, anyways, to hear that it truly is. I mean, they have to pay rent first, right? It's kind of the above all else, you got to pay your rent. It's one of those kind of aspects that we talk about as a benefit of real estate, and it certainly is kind of you can see it happening right now, that it is a top focus. So I don't want to go too much off course here. So let's switch back to Rob. If you can kind of talk sort of a similar discussion on the debt side. Then borrowers kind of able to pay debt service. What are you seeing on your side, and what can the debt funds do to try and protect the value of their loans as we're working through some of this stuff?
Yeah, I mean, I think can companies continue to pay debt service? I think most will be able to, and some certainly will not. Yeah. And we've seen some estimates for syndicated market default rates to end the year somewhere around 10%. That would compare to financial crisis peaked out at the end of 2009 in the kind of mid to lower teens. So we'll see. I mean, we may match those numbers from an overall market default rate. I think the impact that has for investors very much is dependent on the duration of this downturn and the duration that risk-off sentiment occurs. Because at some point, if a lot of these defaults occur and happen and resolve themselves in an environment where markets are better, the impact of that default rate tends to be a little bit less so on the market. So, it's kind of an interesting dynamic. I think in terms of, us as portfolio managers and asset managers, and how do you protect value, it's different versus, I would say, public debt versus private debt. So in the public markets, where, you own a portfolio of assets, you certainly have trading ability on those assets. It's very much a process, I think, of constantly re-underwriting your exposures and understanding how do these companies survive in a deep recessionary environment. And for many of those positions, when you underwrite them initially, you plan for some sort of recessionary environment. That's part of your downside protection. But every cycle is different, and I think you really have to focus. You got to reach out to those companies, understand what's going on, and understand how much liquidity do they have, and can they survive. And, for the purpose of your position, how much asset coverage is there beneath you, and how can you access that asset coverage if you have to. And, you may find early on, if you can be quick, that there's names that you want to exit, but it may not be the other case on the other side, or your positions that you can hold. On the private side, it's a little bit different, because in most of those instances, you're a bilateral, lending agreement where, in many cases, you're the only lender. Now, for those deals, when you're in the top of the capital structure, most of those still have financial covenants. So you have kind of that early warning signal. But assuming one of those gets tripped, you got to dig deep, and you have to figure out how can you maximize your value and what's the right thing to do. A lot of these companies are backed by private equity firms. They may come to you first and say, well, you need to relax our debt terms. Well, maybe you got to go back to them and say, we'll do that, but you need to put in additional capital to bridge the liquidity gap that a company might have. And if they're not willing to do that, you really have to start to plan, how can I maximize value in these situations? Do I go at it on my own? Have we reserved liquidity that we can set aside to support some of these underlying portfolio companies that we might have? Or in some cases, you need to really, turn the screws a little and start to say, bankruptcy may be the best option here. You get the courts involved. It kind of puts a lot of belts and suspenders on some of these situations, and that may be the best way to protect your value and protect your asset. And you might have to take ownership of those companies and really be prepared to own them to maximize your value. So, I think it depends a lot based on the types of situations you're involved in and the markets you're in. But, to me, it really, you got to have a lot of people focused on it. You need a lot of size, a lot of scale. It's going to create a lot of busy times, especially if this drags out and default rates, really do go into the mid-teens, because, every situation is going to be different and unique, and it's going to take a lot of time. But those are the things that you ultimately have to do to try to protect your value and maximize returns
Sure.
in these environments.
Perfect. Yeah, that's great. I appreciate that. So Randy, let's switch to you. If you could just maybe talk a little, and I know you recently kind of wrote, I think you wrote about this in an investor letter, but can you talk a little about how your fund was positioned in the beginning of the year going into this, and have you made any adjustments to the portfolio, and why, and kind of in terms of before and after this all started?
Yeah, I mean, one of the things is that it's very hard to be defensive once you're already in a crisis. So you've got to sort of be preparing for where risks are asymmetric in the marketplace. So as myself and my associate portfolio manager were, looking out a little bit, we started to see, things that, prices were relatively high in real estate, or, conversely, cap rates were low. We saw that we were getting longer, of course, into, one of the longest economic expansions in history. So with that said, we thought the economy had some more fragility in it. I wish I could tell you that we had the foresight to see something like this coming. We certainly didn't expect a pandemic, nor was a recession part of the forecast, but we were expecting much slower GDP growth, much slower job growth, because we were already really at full employment. There was just not a lot of gas sort of left in the tank if you think that the consumer is about 70% of overall GDP. So, really for the last year and a half, and then particularly even over the last, 6 months going into this year, we got very defensive. So just on the sort of private equity side of the portfolio, we moved that down, and really took that to about 55% of the overall portfolio in the first loss position. We focused on the sectors that we felt to be most defensive, and certainly the four main food groups. And similar to earlier conversations, we certainly feel that multifamily and industrial are good places to be. And I do want to echo the comment that so far in our portfolio too, we're seeing very high levels of collections on the multifamily side. And one of the other interesting things is on multi is that food, clothing, and shelter are still really the fundamentals of life, and you need a place to stay. So these properties are still full. You got a month of security deposit in those properties. There's really no multifamily or anything really getting developed right now. And unfortunately, like you see coming out of financial crises, it's going to be difficult for folks or new household formations to buy more single-family housing. A lot of that benefit, as well as demographic shifts, will inure to multi. So being really first of all, underweight in the first loss position on the private equity side, sticking to multi and industrial, we think will prove to be very resilient over time. We also have a pretty significant, almost less than half of the market weight to retail. And in our office, we have an underweight as well. And some of the office that we have, it's even included in that underweight. Government office is really a very different kind of office as opposed to multi-tenant. And we do have some basically life science, which accounts for basically just lab space, if you will. And obviously that is a very resilient asset class, and perhaps even more resilient than we had thought, given the nature of this particular downturn. We also then took some positions, really high in the capital stack and invested in some debt. We think that's going to be opportunities are going to be very accretive going forward. With lack of liquidity, there could be some very great assets that are just cash flow inconvenienced, and I think to be able to provide some additional debt financing at nice spreads will materialize over the next little while. And then we increased the liquidity of our portfolio as well. So we wanted to make sure that we had plenty of cash to take available of opportunities. So we do think we'll see some dislocations. I mean, for example, the public REIT market, which has great high quality properties, always sort of tends to overreact. If you think about going back to the GFC, the public market overreacted to ultimate sort of price discovery by a factor of almost 3 times, with the private market finally settled on. So as we look out, having that cash is going to allow us to lean into the publicly traded REIT market when we see big discounts in net asset value, to take advantage of some debt opportunities and to move forward in that direction. But we stayed core, we stayed low leverage, we didn't draw on any of our lines of credit, and having that flexibility going forward will allow these dislocations to be potentially profitable for us as we move forward.
Okay, perfect. And sorry about that. I switched slides there too quickly. I didn't mean to do that. But now we're going to move on to discussing transactions and valuations. And I will say there's so many interesting things to discuss. I'm worried we're going to kind of run out of time. So I might ask our speakers. I might sort of skip through a few things just as we're getting closer towards kind of being tight on time. So I'm going to I definitely want to talk about transactions and valuations. I think it's a huge kind of topic and concern in the markets, and then maybe we'll sort of skip through some of the other stuff. But let's move on to this. And so, Rich, maybe we could talk a little bit about transactions and valuations and NAVs. Starting kind of on real estate transactions. I mean, those have really fallen. Fewer transactions. How does this start to impact valuations and NAVs? And kind of what are you doing with the fund, in terms of kind of validating valuations? And can you be buying and selling during a time like this? Does it work, or do you need to wait? What's your kind of view on that?
Yeah, no, it's a great question. It's definitely slowed down. I think the interesting part of it was deals that were awarded pre-crisis and what happened there. And I think you had some groups just go through, buy at the price they had agreed to, thinking that this is a short term or this would have a V-shaped recovery. You had some groups walk away or ask for a price reduction. Most of those just didn't sell because sellers weren't willing to reduce the price. And then a lot of the instances you've had due diligence or contracts pushed out 30 to 60 days to wait and see what's really happening. Are tenants paying? Do we need to modify our underwriting, etc.? Regarding transactions, it's definitely slowing down. I mean, people can't travel, so you can't do site tours. Talking with brokers, though, once we get to some normalcy, there's going to be a lot of transactions, as they just told sellers to hold off and we'll bring it out once we get to some normalcy. So I think it will open up. We've got quite a bit of dry powder for our Global Cities REIT. What we've done with that, we're holding a little bit more cash when we pay down some debt. We were already low leverage. We're even more lower leverage today, which I think will provide us some good opportunities. Regarding valuations, we do all of our valuations by a third party, and we've hired one of the largest third-party appraisal managers. And why is that important is that they have a number of clients, and they also work with other appraisers to ensure that the market is consistent. typically in our fund, under normal conditions, you'd have a third of your portfolio appraised each month. But during times like this, you can move appraisals that was going to happen in June. You can move them to April. So we're seeing that as we've got this dynamic environment. But I think it's important that you do have third parties and groups within the market that are working with other parties to ensure that the market is consistent on how they're valuing direct real estate.
Okay, sure, perfect. All right, so then, Rob, in terms of the debt markets, I mean, how are transactions trending there, and is there price transparency? I think you touched on it a little bit, but similar to real estate, is it kind of tough to value the underlying collateral, and what are you doing about it as a firm and a fund?
Yeah, there is, again, it depends on public versus private. So in the public markets, you do get price transparency, and you do see issuance. And there is, I think, liquidity for companies to get deals done. It's obviously more expensive and maybe a little bit more situational, but if you look at the high yield market on Friday, Ford, priced an $8 billion deal that I think was the 5th largest deal in the history of the high yield market, occurring amidst this type of pandemic. So, in that environment, you do see things getting done. I think on the private side, similarly, use third-party valuation firms to mark those assets to market to the best that we can. And they're, at least I think in the private corporate debt markets, you do have this analogous public corporate debt market that can provide some indication of, what's happened to discount rates, what are spreads, how do you think about if things were, comparable from a rating perspective, just where are those things trading in the market, and can provide some degree of price transparency. If you can't directly view a transaction that you're looking at, one buyer to one seller, you can certainly get an indication of where deals like that are trading in the market. I think from the investing side, these markets were so strong coming into this that there is a fair amount of dry powder, and I think a lot of people that are willing to do deals, and that capital can be there. I think that the initial indication from a lot of fund managers, and ourselves included to some extent on the private side, is let's take care of our own book first. Yes, maybe theoretically we have liquidity and have capital to go out into the market and see if, is there anyone that really needs to access money right now or seeking to do it. But, first and foremost, you want to protect your own book and make sure your existing borrower base is as good as they can be, because that obviously directly impacts your valuations. But, funds, and whether it's, BDCs or other funds, we have levers to pull, and I think if funds were properly managed and had properly diversified sources of leverage, weren't too close to your limits, didn't have too much mark-to-market exposure, that, you have an ability to navigate this, and you may have some dry powder to go take advantage of opportunities when they start to come. And so it's a combination of those two things. But I think there is some degree of price transparency, and some dry powder to go take advantage of opportunities, and at a minimum to protect the value of your book, but at some point to start to gain and capture additional return opportunities in the marketplace.
Okay, perfect. And Randy, let's switch to you now, if you don't mind. I think I'm going to kind of combine some of the questions on the next section here, just in the interest of time. So I think, if you don't mind, Randy, if you want to talk a little bit about the kind of the transactions and the valuation side of things, as well as, and you already touched on this a little, kind of the, liquidity, how you're managing liquidity for the fund in this environment. But, maybe if you could sort of talk together about the valuation side, assessing opportunities, and then managing liquidity, that would be great.
Yeah, listen, I think, I think like everyone, I think on the real estate side, you have very highly competent and competent third-party valuation experts that follow, standards. And Those standards are very important, and they've been widely adopted and used in the institutional investing world for a long period of time. Those standards require them to take a look at all market conditions and fairly reflect those values. And so we as well rely on those values as does the Global Cities Fund. So not a lot to add there other than I think the system and process works pretty well in that regard. And it's been going on for 40 years in institutional land. And when folks talk about institutions, I think sometimes we forget that those institutional investors largely are people in pension plans. So ultimately, it's individual investors that are getting or were getting in the defined benefit plan days their exposure there. So we feel pretty good about that. And what was the second question you wanted me to ask?
Liquidity. So how are you handling liquidity in the fund?
Yeah. So, interval fund's a little bit different than a daily NAV REIT or some other types of, in that, except under a very small set of circumstances, we need to be able to provide 5% of liquidity to the investor on a quarterly basis. So what you want to make sure that you do is have liquid securities. You want to make sure that you don't have too many unfunded commitments, because chances are capital raise for all of us is going to be more difficult when you can't get out there and tell the story, and as people are trying to figure out whether they have jobs or don't have jobs. So making sure that you've got cash, liquid securities, on lines of credit, because again, kind of what we talked about, it's important to play defense, and that defense is having liquid securities available, but there's also a time to play offense. And so as that third leg of which is really the virus, starts to mitigate and life looks like it's going to return to normal, markets move ahead of that. So, if you think about real estate back in 2009, it was a year when real estate probably had its lowest, actual prices that were going off in the marketplace. But the public real estate market put up a return, depending on the index, that was in the high 20s, low 30s kind of number, because they were saying, listen, people that have money are actually starting to transact, and firms that have good businesses are trying to lease more space, and it led to a strong uptick in ability. So I think in order to be able to play offense, you have to start with defense. And so for us, we started playing defense before going into 2020, and that'll allow for us to be able to take a step forward and actually play the other side of it, be able to creatively take advantage of some of the dislocations that are likely to occur over the next while.
Sure. Okay, good. Perfect. Okay, so just a couple of other questions on kind of leverage. I think, and Rich and Rob, I might ask you. So Rich, Rich and Rob, I think, and Rich, maybe we'll start with you. But I think, the big question out there is, can owners of commercial real estate properties get funds that they need to get through this? And I know, Rich, you touched on it a little bit. It sounds like, there's enough liquidity and enough kind of willingness to work with owners of real estate on the landlord side. You're going to work with them on the debt side, though. I mean, if you feel comfortable talking about that, I mean, do you think the commercial real estate lending environment is kind of better off going into this environment than we were back in the 2007, 2008? And are you noticing kind of any less or more challenges related to debt at this time, commercial real estate debt? And then after that, Rob, maybe we can go to you on the kind of accessing capital on the commercial debt side, or the corporate debt side. So, Rich, do you mind starting with that?
Yeah, I can touch on overall today versus before the global financial crisis. I definitely think overall we're in a much stronger place than we were back in the GFC. If you look at CMBS issuance from 2017, 18, 19 versus 05, 06, 07, it's less than half of what it was before the GFC. So less competition there. I think on life cos or other lenders, I think it's been much more disciplined in underwriting transactions versus pre-GFC days. I think they're looking at in-place cash flow now, or have prior to this, versus pro forma NOI. I think proceeds has been much more disciplined, ensuring that the borrower or sponsor has hard equity or equity in the transaction. And I think across the board, the market's been much more disciplined. Where we were losing deals on the lending side is on pricing and structure and relationship, versus in the global financial crisis, you're losing it because the other guy was willing to give more lever or higher leverage.
Okay.
And I think the covenants have held up, although the asks have been getting a little more aggressive recently, but I think they've held up versus a covenant light environment pre-GFC.
Yeah. Okay. Okay, great. Yeah, and Rob, how about you on the corporate debt side? I mean, I've definitely heard the the kind of the Covey light story, that that side has been kind of increasing a little bit, but that still not as bad as pre-GFC. Are you seeing the same thing, kind of a similar type of scenario?
Yeah, it depends. I do think on the real estate debt side, to echo the sentiments before, where you have, and you can look at it, debt service coverage ratios that are much better than they were in the financial crisis time, as well as average loan to values that are in much better shape than they were at that time. And from that standpoint, obviously every downturn will be different, but I think, lenders are better positioned on average heading into this. In the corporate markets, it depends on the market. In the loan market, the senior secured loan market, and more on the public side than the private side, yeah, I mean, there was much greater prevalence of covenant light than we had, even back in 2007. And it remains to be seen what sort of impact that has on the market, because, let's not forget, in the financial crisis, covenant light loans on a recovery basis actually recovered better than covenant heavy loans. I'm not sure that type of situation will repeat itself today, because you have had, fairly significant weakening of structures beyond covenant. So, the types of belts and suspenders that might be there to protect your asset value has deteriorated in the traded loan market, for instance. And as well, one of the other major changes is there's been a large shift in the market to lower rated issuers from higher rated issuers. So for the loan market in particular, a much higher percentage of the market is comprised of loan-only single B issuers, whereas before you had a much higher prevalence of issuers that were issuing both bonds and loans, where the loan, and the nice thing about that is it gave you a bond that you could equitize or wipe away if you ran into a bankruptcy and protect the value of the loan. In the high yield bond market, though, you haven't had that. While sure, structures were a little bit weaker, the quality of the market in terms of looking at it by average rating is basically as high as it's ever been in its history. And so from that standpoint, we've actually favored the high yield market in a lot of our funds vis-a-vis the syndicated or traded loan market, because we view the high yield market as offering better risk adjusted returns and didn't suffer from a lot of these same problems that have kind of plagued the loan market. So it's interesting dichotomy between markets, and you see different things, and, touching on themes from before, you got to know what's in these deals. You got to know these documents. You got to know your asset coverage and what's there to protect you, because there are some aspects of it that are much weaker and very different than they might have been, 10 or 12 years ago.
Yeah. Okay. Great. All right. So we're definitely kind of running a little short on time. I think I do want to give you guys each just a minute or so to just, and let's, if you don't mind, just sort of being kind of short and succinct on this, but I do want to give you just a minute, just real quick, kind of, in the world that you cover, sort of, and I know you can't be too specific, and there's a lot of unknowns, but as much kind of, your insight into what returns and volatility might look like over, the next 12, 18, 24 months, I think, again, just sort of helping the audience and who are, really kind of struggling and stressing to help their clients and setting expectations. If you could just sort of, Rich, why don't we start with you, and if you can just, sort of briefly touch on your kind of expectations for returns and volatility.
Yeah, happy to. I think when you've got strategies that are I think the strategies where you're going to see higher volatility and returns bounce around are the high leveraged strategies that have exposure to shorter term leases or no leases, such as hotels and gaming. I think you continue to see volatility there. I think lower volatility on obviously lower leveraged vehicles that were more defensive going into this, that have well leased properties and are diversified. So it will be interesting times going out. I did touch on at the beginning on the first question on where we think the winners coming out of this will be really in industrial, multifamily, technology, and healthcare related. We really like, and I just think you're going to see continued struggles in discretionary retail, commodity office, co-working, etc.
Okay, perfect. So Rob, how about you on your side, if you can kind of do the same?
Yeah, I mean, I think, a theme that I touched on in the intro, when you look at, a market like high yield as a proxy for sub-investment grade corporate credit, over 2 years, so over 24 months, following spread levels getting to where they've been and where they are, there's never been a negative return over a 2-year period of time. And in fact, the 2-year annualized numbers, depending on how wide the market is at the point in time that you measure it, you're looking at, mid-teens to as much as, let's say, 20% 2-year annualized returns. So, you can't promise anything like that, and every
Right.
cycle and downturn and recovery will be different. But I do think it goes to show the type of dislocation we have seen across credit markets and the opportunities that it creates through distressed investing and fallen angel, investing and increases in defaults, and just this sort of broad category of opportunistic trades can create some really good opportunities. It may be a little bumpy. That volatility is probably going to be there. But I think it can really reward investors that can take the long view in some of these places and commit to it.
Sure, perfect. Okay, and then how about Randy? How about you? Can you?
Yeah, I think those comments are great. Listen, I think it's going to be. I think bumpy is a good name for any risk asset class. I think we'll see lots of bumps regardless of the asset class you're looking at. I think there's going to be large dispersion. I think so. Look for dispersion. So I would agree. I mean, some of the winners coming out of this that you will briefly mention, but data centers, cell towers, industrial, multifamily, life sciences ought to do really well, and there's clearly going to be some losers coming out of it. But when you look across, again, thinking about the ideas when spreads in the credit market are that wide, it's also sort of true, same kind of statistics look on the publicly traded part of the portfolio and some of the liquid debt parts of real estate as well. So we run a 4-quadrant, approach, so we can move between quadrants and opportunities. And if you look at where REITs are trading by historical standards and where the yields are relative to the 10-year treasury or other sort of benchmark numbers, and where they're trading relative to NAV, where spreads are trading in some of the more liquid debt securities, we see some tremendous opportunities, but there's certainly going to be some bumps in the road. But I think at the end of the day, investing is all about the long term. It's all about staying diversified, staying the course. Ultimately, if you got good quality assets, whether they're real estate or credit or underlying equities, they'll do well over a long period of time. In core real estate, over 5 to 7 year period, my expectations haven't changed that it's an asset class that can deliver a large part of its return from income, kind of in that 4 to 6% range, and kind of match appreciation based on the inflation rate. So you got to kind of stay the course. And I think there's good opportunities going forward, but bumps and volatility certainly are in the cards for everyone, and that's true across risk asset classes. But I don't think no one ever makes a whole lot of money by trying to time a bottom and trying to time a top. It's making sure you're staying invested, staying diversified, and doing the right thing.
Right. Okay. Great. Thanks, guys. So just gonna. I know we're at the hour here, so I don't want to take too much time on this, but we did want to provide some due diligence action steps, and so. There's so much going on, so much news and information being thrown at us. We just wanted to provide some real specific steps you can take with working with your clients. And I'd like to thank Mick and Associates for providing us with this list of steps. And MIC is one of the due diligence firms we work with frequently. And of course, they, along with the others, they've been proactively monitoring what's happening in the industry. And so they shared some of their top suggestions with us here. And I think the first one is really important, which is really just to monitor for any suspensions of an offering, share redemptions, or distributions. So if you see any changes to any of those kind of aspects of a program, really important to be monitoring it. You can actually do this on AI Insight by setting up alerts for the funds you have exposure to. So one way to do that, and it is really important to do. And then, of course, when you see that, when you see an action of any kind, you want to immediately communicate any of these with your investors. And again, I think another aspect of this is to be proactive. I mean, proactively communicate the potential, just like they're saying there's going to be bumps and volatility. You want to make sure you're having those conversations with your clients as well, but also, the potential for some changes in potentially distributions, offering maybe share redemption programs, just the potential for it to happen. It might not, but the more kind of proactive you can be in communicating, as I'm sure you all have been, the better and more helpful for your clients. And it's a way to reach out to them and discuss broader financial planning topics as well that may be helpful for them. So a way to reach out and something to discuss. The next few questions are topics that you should be asking sponsors and really, any sponsor you have exposure to in your book of business. And if you're not the one asking the questions directly, then just be sure that someone is asking them on your behalf. And these questions include, has the sponsor taken any proactive measures to protect asset value? We heard some great, information about ways that they can be doing that. I think that was really helpful to hear that there are certainly ways they can be, and kind of knowing what they're doing and sort of documenting that you've done that review is helpful. Are they providing specific information to investors in offering materials and in public filings about how COVID-19 currently affects and may reasonably affect in the future operations and liquidity of the sponsors and their programs? And this is something the SEC's advised that it intends to monitor. So funds are kind of adding risk factors to their offering materials and other things like that. You want to make sure they really are communicating about the potential impacts of this. Are they able to service their debt and portfolio debt? Is the sponsor able to continue operations without syndicating additional offerings? And kind of just really reviewing the financials. Are they adjusting distribution policies? And then the next couple that Mick and Associates provided are topics we didn't cover today. I think they're helpful, and we really wanted to make sure we had these. So, for oil and gas sponsors that use reserve-based lines of credit, are they appropriately prepared to address borrowing-based deficiencies and related loan repayments in the event that their credit limits are adjusted due to lower commodities prices? I think it's an interesting question to be asking and really helpful that Mick provided the specific question on that. And then for qualified opportunity fund sponsors with identified asset funds, what adjustments are they having to make to development timelines? And, kind of talking about that whole uncertainty of outcomes on things that have already been acquired. It's important to talk about that, and are they going to be able to meet their timelines on qualified opportunity funds, since that's such an important aspect of those. So some good steps from Mick and Associates. Again, we'll send out the replay of this, and I'll recap in a probably a blog or a letter here. But anyways, I think that's it actually for the discussion part of the webinar. I'm going to turn it back over to my colleague Jen Ronan to open up the Q&A. Jen, do we have any questions this time from the audience?
Yes, Laura, thanks. We do have a question from the audience.
Okay.
The question is for Rich. Are tenants with business disruption insurance able to submit claims for the pandemic, or is this considered by insurers an act of God?
No, typically insurance doesn't cover it.
Okay, so most of them aren't able to. I know that's definitely a question I've heard before too, is are they able to do it? So you think the majority of time they're not able to?
No.
Yeah, okay. All right. Any other questions, Jen?
That was the only question from the audience. Is there anything you want to add, Laura?
No, I mean, I think that concludes it. I really, again, just want to thank our speakers, Rich, Rob, and Randy, again, for your time and your valuable insights. I mean, those were great. I feel like we could have talked for a lot longer, and just really appreciate your time. And listeners, thank you for taking the time out of your busy days, and just everyone stay safe and healthy, and thanks again, everyone.